While the world focused on rate cuts, CPI prints, and equity volatility, the real event happened inside secured bullion vaults and exchange warehouses. On screens, silver traded as a number, liquidity flashing, spreads tightening, paper claims multiplying. In physical space, bars were counted, pallets reclassified, and access quietly narrowed. This is not a story about markets reacting. It is a story about paper obligations colliding with finite metal. Every systemic failure begins the same way. Abundant liquidity in abstraction, scarcity in reality. Arbitrage bridges the gap until it doesn't. Margin absorbs pressure until it can't. What followed was not an announcement, not a law passed in daylight, not a confiscation convoy. It was administrative, contractual, and entirely legal. A modern 6102 does not require soldiers. It requires custody rules, emergency clauses, and a redefinition of delivery. This narration traces how silver, long dismissed as too small to matter, became a point of system stress, how paper claims outgrew vault capacity. What appeared to break was nothing. Silver traded normally, volume printed, charts updated. The screen showed continuity. The public saw price fluctuations explained by macro headlines, rate expectations, dollar strength, algorithmic flows. Commentators discussed positioning. Analysts debated sentiment. To most observers, silver was simply another volatile line on a screen. What actually happened occurred elsewhere. Inside vaults, inside inventory reports, inside settlement schedules. While the screen suggested liquidity, the physical system began to behave differently. Bars moved more slowly, certain forms became harder to source, delivery windows widened without announcement. None of this registered in the price. The market looked alive. The supply chain was tightening. This is how systemic stress begins, not with a crash, but with divergence. The screen remains calm while the dock becomes quiet. Paper continues to trade, while Physicate L metal hesitates to move. Nothing failed publicly, but the conditions for failure were forming. The mechanism is mechanical, not emotional. Step 1. Paper liquidity expanded. Futures, ETFs, swaps, and unallocated accounts allowed exposure to silver without requiring physical metal to change hands. This increased apparent supply. Step 2. Arbitrage reinforced the illusion. As long as futures prices tracked spot and delivery was assumed possible, arbitrageurs sold paper and hedged risk. The system appeared efficient. Step 3. Physical demand quietly increased. Industrial users required delivery. Private holders withdrew metal. This removed liquidity from the physical side, while paper liquidity remained unchanged. Step 4. Margin pressure absorbed the imbalance. Instead of forcing delivery, volatility was managed through margin adjustments. Price moved. Collateral changed hands. Metal did not. The analogy is a queue. The screen shows tickets being issued rapidly. The dock processes people slowly. As long as no one asks how long the line is, the system appears functional. This structure mathematically implies stress. When claims grow faster than deliverable supply, the system depends on confidence, not capacity. Institutions understood this. They monitored flows, not prices. At this stage, escalation is subtle. First came small margin adjustments. These reduced speculative pressure without addressing delivery. Then came localized liquidity withdrawal. Certain products became less available. Bid-ask spreads widened off-screen, while headline prices remained stable. Historically, this phase rhymes with 2008. Liquidity did not vanish all at once. It retreated to the core. There were no halts, no rule changes yet. But the latter was already in place. Each rung increased system stress by concentrating risk inside institutions tasked with settlement. Signals existed, but they were quiet. Dealer premiums diverged from spot prices. Delivery times lengthened. Some products required substitution or delay. Inventory reports showed movement between categories. Metal classified as eligible did not automatically become registered. Availability was conditional. Industrial buyers began to secure supply further in advance. This reduced float. None of this changed the screen price meaningfully. But together, these signals indicated a liquidity vacuum forming where paper claims met physical limits. The market did not react. It continued. And that continuation was the signal. What visibly broke was logistics. What the public saw was nothing at all. There were no headlines about shortages, no alerts about failed delivery. Exchange reports continued to publish inventory figures on schedule. From the outside, silver appeared present, counted, and accounted for. What actually happened was a shift in behavior inside the physical system. Bars stopped leaving at the same rate they had before. Transfers that once took days began taking weeks. Certain forms of silver became temporarily unavailable, then quietly substituted, then deferred. The dock slowed. The screen did not. This was not a run. It was a reallocation. Metal moved inward, not outward. From open circulation into controlled custody. From optional availability into conditional access. The public saw stable inventory numbers. Institutions saw declining mobility. The causal chain was straightforward. Step 1, physical demand became inelastic. Industrial users required specific forms of silver on schedule, regardless of price. This removed optional supply from the system. Step 2, discretionary holders withdrew metal. Bars left exchange-adjacent vaults for private storage. This reduced deliverable inventory without reducing reported totals. Step 3, arbitrage incentives weakened. As physical premiums rose independently of futures prices, the profit motive to convert paper into metal increased, but execution became uncertain. Step 4, institutions preserved liquidity by slowing delivery, not by defaulting, but by reprioritizing, reclassifying, and delaying. The analogy is a bottleneck. The pipe remains full. Flow continues. But the exit narrows. Pressure builds upstream without changing the visible level. Margin pressure did not resolve this. Raising collateral requirements changed behavior on the screen, not at the dock. This created institutional exposure. Custodians were now responsible for more claims against less mobile metal. This phase marked the first quiet escalation. There were no margin spikes yet. Instead, access friction increased. Contracts were honored, but with flexibility. Delivery windows expanded, optionality clauses were emphasized, settlement language became precise. Historically, this rhymes with the early phase of the 1980 silver episode. Before rules changed, before limits were imposed, physical availability tightened first. Each delay increased stress. Not because metal was gone, but because confidence depended on timing. The latter advanced without announcement. Signals multiplied, but remained fragmented. Dealer premiums stayed elevated despite stable futures prices. This was dismissed as retail noise. Inventory reports showed metal shifting between classifications. Eligible silver increased, registered silver did not. Industrial buyers began locking supply with longer contracts. Spot availability thinned. These were not alarms. They were indicators. The screen remained liquid. What visibly broke was confidence in equivalence. What the public saw was continuity. Paper silver continued to trade without interruption. Contracts rolled, ETFs rebalanced. The screen suggested depth and resilience. To most participants, nothing had changed. What actually broke was the assumption that a paper claim represented a realistic path to metal. Requests for conversion increased, not all at once, not loudly, but enough to matter. Some holders attempted to move from paper exposure to physical settlement. Others simply asked about terms. Response times lengthened. Clauses were cited. The screen implied abundance. The dock implied scarcity. This was the moment when divergence became structural rather than incidental. The mechanism was embedded in design. Step 1. Paper claims multiplied faster than physical stock. Unallocated accounts, futures, and ETF shares referenced the same underlying inventory. This was efficient in normal conditions. Step 2. Rehypothecation increased leverage. The same bars supported multiple obligations. This reduced idle metal and increased apparent liquidity. Step 3. Arbitrage linked paper to physical until it didn't. As long as conversion was assumed frictionless, pricing stayed aligned. Step 4. Physical premiums broke the link. When acquiring metal required waiting, substitution, or negotiation, arbitrage failed to close the gap. Margin pressure responded on the screen. Volatility increased. Collateral demands rose. But margin cannot create metal. It only redistributes claims. The analogy is a vacuum. Paper trading removes air from the system, creating apparent motion. Physical metal is the sealed chamber. Once pressure equalizes, movement stops. Institutional exposure expanded quietly. Custodians now carried settlement risk that could not be hedged with price alone. Escalation accelerated here. Margin requirements increased again. This reduced speculative length, but concentrated exposure among entities capable of meeting collateral calls. Liquidity retreated from peripheral products. Certain contracts thinned. Depth became conditional. The historical rhyme is 2022, during the nickel halt. Price discovery failed not because of volatility, but because physical settlement threatened institutional solvency. Rule changes were discussed internally, not announced, modeled. Each step reduced optionality for claim holders while preserving continuity on the screen. Stress increased by compression, not collapse. Signals became harder to ignore. Dealer inventories showed persistent depletion in specific forms. Bars were available, just not the right ones. Delivery delays normalized. Weeks replaced days. Inventory classifications mattered more. Eligible metal accumulated. Registered metal stagnated. Industrial demand remained firm. Substitution was limited. These signals pointed to the same conclusion. Paper claims were liquid. Physical metal was constrained. The market continued to trad. What visibly broke was coordination. What the public saw was routine risk management. Clearing members issued notices. Exchanges adjusted parameters. Custodians updated documentation. None of this appeared extraordinary. It was framed as prudence. What actually happened was internal alarm. Risk committees convened outside normal cycles. Exposure reports were rerun with new assumptions. The question shifted from price volatility to delivery viability. Institutions did not fear silver's price. They feared its movement. The screen continued to function. Behind it, the system prepared for containment, and the mechanism followed institutional logic. Step 1, clustered delivery risk emerged. Conversion requests were no longer random. They correlated with stress elsewhere in the system. Step 2, liquidity removal accelerated. To preserve solvency, institutions reduced optional exposure. Credit lines tightened. Inventory buffers were isolated. Rising collateral requirements forced weaker participants out, leaving fewer, larger entities holding settlement obligations. Step 4, internal exposure became asymmetric. Losses were capped by rule. Delivery failures were not. The analogy is a vacuum chamber. Air is removed gradually. Movement appears smooth. Then, at a threshold, structure matters more than flow. Arbitrage ceased to function as a stabilizer. It now amplified stress by funneling claims toward the same physical endpoints. This created panic, not public, but procedural. Institutions moved to protect continuity, not fairness. Escalation became explicit. Margin hikes came faster. Then intraday. Certain contracts were discouraged informally. Liquidity providers stepped back. Historical rhyme was clear. In 2008, liquidity vanished not because assets disappeared, but because trust in settlement did. Here, the concern was narrower, but sharper. Silver's physical market was small enough to stress quickly, large enough to matter. Rule changes were drafted, emergency clauses reviewed, force majeure language resurfaced. Each step increased system stress by signaling fragility without admitting it. Signals leaked through process, not price. Dealers reduced size availability. Quotes became conditional. Delivery commitments included escape language. Subject to availability became standard. Inventory reports stabilized numerically. Mobility did not. Industrial buyers began bypassing exchanges. Direct sourcing increased. These were not market signals. They were institutional ones. The system behind it prepared for exception. At this point, panic was no longer about silver. It was about precedent. If delivery could not be guaranteed here, it could not be guaranteed elsewhere. And once that realization settles inside institutions, it is rule change. What visibly broke was neutrality. What the public saw was clarification. Exchanges updated language. Custodians revised terms. Settlement procedures were modernized. Nothing was framed as an emergency. There were no declarations of failure. What actually happened was a redefinition of obligation. Delivery was no longer a binary outcome. It became conditional, contextual, subject to interpretation. The screen continued to print prices. The dock began operating under new rules. This was the moment when risk moved from markets into contracts. The mechanism was legal, not financial. Step 1, optionality was reintroduced asymmetrically. Institutions retained discretion, claim holders absorbed uncertainty. Step 2, cash settlement pathways expanded. This reduced immediate pressure on physical inventory while preserving nominal continuity. Step 3, arbitrage incentives collapsed. When delivery could be deferred or substituted, paper to physical conversion lost reliability. Step 4, margin pressure became irrelevant to outcome. Collateral could satisfy price moves, but not entitlement disputes. The analogy is a gate. It remains open in principle, but only certain vehicles are allowed through. Others are redirected without notice. Institutional exposure was capped by design. Losses could be socialized. Delivery failures could be reclassified. This did not resolve system stress. It redistributed it. This was a major rung. Margin hikes had already filtered participants. Now rule changes filtered outcomes. Halts were no longer necessary. The system could absorb stress quietly through settlement modification. The historical rhyme is 1980. When silver rules changed midstream, the market did not fail immediately. It inverted. Here, the approach was more subtle. No position limits, no bans, just language. Force majeure clauses were not invoked. They were positioned. Each adjustment increased stress by removing certainty while preserving appearance. The latter now led downward without resistance. Signals became unmistakable. Dealer premiums disconnected completely from futures. Price discovery fractured. Delivery delays were no longer exceptional. They were normalized. Inventory categories became decisive. Metal existed, but access required compliance. Industrial buyers treated exchange prices as references, not guarantees. Contracts shifted off-screen. These signals confirmed the shift. The price on the screen remained liquid. The physical system became administrative. At this stage, the question was no longer whether delivery could fail. It was who would be allowed to receive metal and who would receive an explanation. The system had chosen continuity over equivalence, and in doing so, it accepted default risk as a tool rather than a threat. What visibly broke was trust. What the public saw was stability. Prices continued to update. Contracts continued to clear. Official inventories appeared sufficient. What actually happened was a physical drain that no longer reversed. Metal stopped re-entering circulation. Withdrawals became one-directional. Transfers moved inward, toward fewer vaults under tighter control. The dock fell quiet. The screen stayed active. This was no longer a liquidity event. It was an ownership event. The mechanism completed its cycle. Step 1. Physical metal concentrated. Bars accumulated in jurisdictions and vaults where access was most restricted. Step 2. Remaining liquidity became circular. Paper claims traded against each other without touching metal. Step 3. Arbitrage fully collapsed. There was no reliable path from screen price to physical delivery. Step 4. Default risk became administrative, not declared, managed. Margin pressure ceased to matter. Liquidity no longer reached the point of stress. The analogy is a sealed chamber. Movement continues inside, but nothing enters or exits. Pressure exists, but it cannot equalize. Institutions were no longer exposed to volatility. They were exposed to legitimacy. The system functioned by narrowing eligibility rather than resolving imbalance. The final escalation was silent. Margin hikes stopped. They were no longer necessary. Halts were unnecessary. Trading could continue without settlement integrity. Rule changes had already done the work. Force majeure no longer needed to be declared. It was implied. The historical rhyme here is broad. Every systemic failure ends this way. In 2008, settlement froze. In 2022, trading halted. Here, continuity masked exhaustion. Each step reduced visible stress while increasing structural fragility. The latter ended not in collapse, but in separation. Signals converged. Dealer premiums became permanent, not spikes, baselines. Delivery delays became indefinite. Schedules lost meaning. Inventory reports stabilized. Movement did not resume. Industrial buyers secured supply outside the system. Price became secondary to certainty. These were no longer warnings. They were outcomes. The screen price persisted. The physical system closed ranks. At this stage, default risk was no longer a question of failure. It was a question of recognition. Final intelligence conclusion. The price on the screen continued to suggest liquidity. The physical system reflected constraint and control.